Ladies and gentlemen, good day and welcome to UPL Limited Q2 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anurag Gupta. Thank you, and over to you, Mr. Gupta.
Thank you, Renju. Good evening, everyone. I am Anurag Gupta, Head of Investor Relations at UPL. On behalf of the UPL management team, I thank you for joining us today for discussing the financial performance for Q2 and H1 FY26. The investor presentation, press release, and the financial statements have been made available on our website, and we take it that you have read the Safe Harbor Statement. From the management team, we have with us today Group Chief Operating Officer Toshan Tamhane, Group Chief Financial Officer Bikash Prasad, CEO of Global Crop Protection Business Mike Frank, CEO of India Crop Protection Platform Ravi Cherukuri, CEO of Seeds Business Advanta Bhupen Dubey, CEO of Specialty Chemicals Platform Superform Raj Tiwari, and other members of the leadership team. Before we begin, I would like to introduce you all to Ravi, our new CEO for the UPL SAS platform. Ravi joined UPL in February 2025 and has taken over this leadership role in October. His predecessor, Ashish Dobhal, has transitioned into his new role as the Global Sales Head for UPL Corp. We thank Ashish for his outstanding leadership at UPL SAS, where he has played a pivotal role in strengthening the business, building high-performing teams, and positioning us for future growth. In this earnings call, Bikash will take us through the overall performance for UPL Limited for the quarter and half year. This will be followed by Mike, who will share his detailed remarks on UPL Corporation, followed again by Bikash, who will cover the other platforms in brief. We will have the Q&A session post that. With that, I now hand it over to Bikash. Bikash, over to you.
Thank you, Anurag. Good evening, everyone, and a very warm welcome to UPL's second quarter and half-yearly FY26 earnings calls. Thank you for taking the time to join us today. Before presenting the financial highlights for Q2, I want to start by expressing my appreciation and gratitude for your continued interest and support. Since stepping into this role as Group CFO in June, I have had the opportunity to meet and interact with several of you from the investors and analyst community who have shared their extremely valuable inputs and feedback in terms of market expectations and insights. This has helped us in looking at the business from an outside-in perspective, giving us a better view for evaluating and reporting our performance. Also internally, we have been working closely, and I'm proud of the momentum we have built together. We delivered a strong first quarter, and I'm even thrilled to report an even stronger second quarter, reflecting robust execution, disciplined financial management, and the resilience of our business model. In today's call, we'll walk you through the key financial highlights of the quarter, provide some context on the drivers behind our performance, and share our outlook for the full year FY26. The second quarter continued to witness a stable demand at farm gate level for crop protection products and seeds. Ongoing geopolitical uncertainties, including US tariffs-related concerns, continue to affect market conditions and trade flows. Further, lower commodity prices-led farm income stress continue to influence overall agrochemical value chain. Additionally, there were some weather-related challenges in India crop protection business. On a positive side, reduction in sulfur rates have had a favorable impact on finance costs. Before delving deeper into the financial performance, I would like to share key corporate updates from Q2. The first one is related to our corporate realignment. In September, we integrated our post-harvest business Deco with our seeds business Advanta. Both businesses share a strong service-led culture and a commitment to delivering sustainable, science-based solutions to farmers and food producers worldwide. The move is expected to bring potential upside driven by synergies in adjacent focus areas, guidance from experienced and proven Advanta leadership team, shared back-end infrastructure, overlapping presence in emerging markets, and enhanced digitization. The second update is on rights issue. Our final call of rupees 180 per partly paid equity share aggregating to around 1,685 crore or $200 million was called for in September. This amount was 50% of the total issue price of rupees 360 per share, comprising rupee 1 towards face value and rupees 179 towards share premium. I am pleased to share that the proceeds from the same have been received in September. The final update is on the recent outlook upgrade. As shared during our Q1 earnings call, two global ratings agencies, Fitch and S&P, had upgraded their outlook from negative to stable. I am pleased to add that in August, Moody's upgraded their outlook as well from negative to stable. This is a strong endorsement of our financial resilience, strategic clarity, and commitment to sustainable value creation. Our actions reflect our continued focus on capital efficiency and long-term stakeholder confidence. Now coming to Q2 FY26 performance overview. We continued with our strong performance and improved further in this quarter. In Q2 FY26, we reported revenue of 12,019 crore, a strong 8% growth versus last year. This was driven by 7% increase in volume and favorably supported by 3% exchange impact, partially offset by some pricing pressure. At the platform level, UPL crop, our global crop protection business, was up by 12%, supported by an even stronger 26% increase in Advanta. I am pleased to share that both these platforms were driven by volumes, indicating our strong market presence and good acceptability of our products. This also indicates a recovery in our global crop protection business from Q1. My colleague Mike will cover this at length in his remarks. While our Superform business remained largely steady, the super specialty chemical segment within it showed a remarkable 18% jump versus last year. This is a testimony of our focus on growing this emerging segment in a strong collaboration with global partners. Our India crop protection business, or UPL SAS, was impacted by unfavorable weather conditions in the quarter, with its revenue declining by 10%. Among key reasons, growth was led mainly by the Americas. Latin America grew by 13%, driven by fungicides in Brazil and Argentinian recovery, while North America was up by 63%, led by herbicide volumes. Among others, India was up by 6%, led by seeds and super specialty chemicals, offset by crop protection decline. Europe was steady, while there was some decline in the rest of the world. Our contribution increased to 5,041 crore, a significant 21% jump versus last year. The margin was around 42%, an improvement of 420 basis points. This was driven by improved product mix, higher capacity utilization, and lower input cost, mainly in crop protection. This also reinforces our commitment to operational efficiency and strategic sourcing leading to favorable cost position. The SG&A expenses amounted to 2,836 crore, a 9% increase year-on-year in line with our expectations. I would like to add here that the Q1 non-cash provision related to distributor restructuring for around $13 million in Brazil was reduced by around $4.2 million in Q2, facilitated by the recovery plan. As highlighted in Q1, this will subsequently unwind over the period of recovery horizon. Higher revenue and improvement in contribution margin led to a strong growth in EBITDA to 2,205 crore, up by 40% versus last year. I am pleased to share that EBITDA margin stood at 18.3%, up by 410 basis points versus last year. Profit before tax, or PBT, stood at 784 crore, up by over 1,200 crore versus last year. This movement was driven by EBITDA at 2,205 crore, up from 1,576 crore last year. Depreciation and amortization expenses increased from 697 crore to 771 crore. Significant reduction in net finance cost, down from 847 crore to 518 crore this year. This was driven by several factors, including debt prepayment of $250 million in March 2025, favorable SOFR-linked interest rate, which have declined by around 125 basis points since last year, ratings upgrade related interest rate reduction, and our focused capital management. Additionally, other factors that impacted PBT were lower net exchange losses, down from 375 crore to 235 crore. Lower losses from associates and joint ventures from 135 crore to 54 crore in this period, as they have had improved performance during the current year. We will continue to monitor the performance of these entities closely. Finally, the exceptional items improved from a negative 8 crore to a positive 142 crore. This was as a result of favorable verdict from Brazilian Supreme Court on a VAT litigation. The gain was partially offset by the restructuring costs for one of our European manufacturing plants. We have also provided a detailed management P&L to better explain the numbers, including net interest and FX costs, as discussed during the last Q1 earnings call. We have also included a management balance sheet, which is slide 20, and the management cash flow on slide 23 for better reference. Profit after tax, or PAT, significantly improved from a loss of 585 crore last year to a profit of 612 crore this quarter. I am pleased to share that our PATMI stood at 553 crore, up significantly by around 1,000 crore versus last year, driven by factors as explained earlier. Correspondingly, our operational PATMI, that is adjusted for exceptional items, rose from negative 434 crore to a positive 411 crore, up by 845 crore. For H1, PATMI was up by around significant 1,300 crore. Moving on to the key balance sheet items, our net working capital in September 25 stood at 15,463 crore, or around 118 days, lower by around 5 days versus an already tightened last year. The amount is higher versus previous year due to improved sales in H1, especially in our seeds business, and overall inventory built up in anticipation of our H2 plans. Inventory days stood at 124 days, up by around 7 days, while payables were at 151 days, up from 127 days last year. Our receivables stood at 146 days, up from 133 days in the previous year. We also saw a flat non-recourse factoring at around $553 million versus $558 million in the previous year. On the net debt, as of September 2025, it stood at 23,802 crore, that is approximately $2.7 billion, reflecting a reduction of 3,729 crore or $605 million compared to 27,531 crore, that is $3.3 billion in September 2024. However, the net debt increased versus March 2025 largely due to the impact of perpetual bond redemption of about $400 million in Q1 and higher working capital requirements in line with the historical seasonality. I am also happy to share that our key gearing ratios, that is net debt to EBITDA and net debt to equity, have shown remarkable improvement compared to September last year. The net debt to EBITDA improved from 5.4 times last year to 2.7 times, driven by a strong operational performance and capital efficiency. This ratio was at 1.7 times in March 25 due to seasonality-led higher collections in that period. Adjusted to perpetual bond, this ratio last year March end would have stood at around 2.1 times. Additionally, net debt to equity improved from 0.9 times last year to 0.6 times this year. On H1, let me summarize the highlights briefly. Our revenue is up by 5% versus last year, with growth led by all platforms, mainly Advanta and UPL Corp. The total contribution grew by 16% at over 9,000 crore, driven by broad-based margin improvement of over 400 basis points versus last year. EBITDA is up by 29% at over 3,500 crore, with robust performance across all platforms and led by contribution margin improvement. PATMI improved by around 1,300 crore, up from a negative 827 crore last year to a positive 465 crore in H1 this year. Similarly, our operational PATMI improved by approximately 1,100 crore, up from a negative of 769 crore to 331 crore this time. I now hand over to Mike, who will take you through the details of UPL Corp. Mike, over to you.
Thank you, Vikas. Hello, everyone, and welcome to our second quarter FY26 earnings call. Before we review the quarter, I would like to start by providing some insights has stabilized. Channel inventories in all major countries are back to normalized levels. Global demand growth is in the low single digits, and prices have largely stabilized. With this backdrop, we are well placed to compete. We are sitting on fresh inventory that is at the right level and at a competitive cost, giving us the opportunity to compete aggressively, to grow our market share, and to expand margins simultaneously. Grower prices for row crops continue to remain low, pressuring farm margins, which in turn creates liquidity stress on retailers and distributors in some regions, especially in Latin America. The breadth of our portfolio gives us optionality to serve farmers with post-patent, differentiated, and biological solutions. The current environment in relation to farmer margins is driving greater interest in post-patent solutions within our portfolio. Looking ahead, we expect this trend to persist into 2025, creating opportunities to strengthen our position in the value-driven segments. Turning to our Q2 performance, the quarterly performance of our business reflects the strength of our portfolio and the operational advantage of our supply chain. In Q2, our revenue grew 12% year on year, supported by strong volumes in North America and Latin America. Looking at the performance of our portfolio, herbicides delivered strong results across North America and Latin America, driven by S-metolachlor, metribuzin, and triclopyr. Fungicides, led by mancozeb, continue to see strong demand in all regions. Our insecticides portfolio was mainly impacted by increased competitive pressure, leading to price erosion of our premium Sperto brand in Brazil, as well as lower volumes of acephate also in Brazil. However, this segment is showing a solid recovery, driven primarily by our growing Feroce brand sales, whose superior agronomic performance has strengthened its brand presence and demand with growers in Brazil. Our sustainable solutions portfolio in Q2 saw slightly lower volumes. However, total contribution margin grew on the strength of improved mix. Impressively, our contribution margins overall expanded to 35.1%, growing by over 400 basis points year on year. This was mainly driven by improved mix, lower input cost, and higher capacity utilization. Turning to SG&A, we continue to demonstrate a disciplined SG&A approach while investing strategically in growth and transformation initiatives. Nevertheless, ECLs totaling approximately $9 million impacted our results, but to a lesser degree than Q2 last year. These impacts were mainly in Latin America. Finally, EBITDA for the quarter increased by 69% year on year, a margin expansion of nearly 500 basis points, demonstrating our ability and agility to compete and drive profitability in this market. Let's now review the Q2 performance of our regions. In Latin America, we posted 10% higher revenues year on year. This growth is attributed mainly to Brazil's robust performance and partial recovery of our business in Argentina. As highlighted during our last investor call, the combination of disciplined execution, a resilient business model, enhanced customer focus, and a robust portfolio has driven a strong revenue recovery in this region. We are confident that this positive momentum will continue through the second half of the year, as farmers across much of the region are in the midst of planting their first crops for the first season. In North America, we grew by an impressive 79% versus last year. While Q2 is a smaller quarter in North America, our performance demonstrates the momentum we are building in both Canada and the U.S. Growth in North America was boosted by a strong herbicide portfolio, with notable upsides coming from the demand for our post-patent portfolio of key molecules such as metribuzin, S-metolachlor, and glufosinate, which delivered significant year-on-year gains in both volume and revenue. This performance was complemented by key fungicides such as mancozeb. While our post-patent portfolio is performing well in North America, we're also in the midst of launching and scaling several new products, primarily in the differentiated and sustainable categories of our portfolio. This all positions us well for sustained growth in this North America region. In Europe, we recorded near flat revenues, which declined 1% compared to the same quarter last year. This was primarily due to fungicide sales normalizing after an exceptionally wet season last year. I'm pleased to highlight that we continue to see sustained growth across key markets, such as in Germany, Italy, Spain, and France. Unfortunately, the market in Turkey has been impacted negatively by an early season frost, resulting in lower sales, especially in the fruits and vegetable market there. We are confident of strong volumes and revenue performance in Europe during the second half, with overall growth projected for the full year. In Africa and Asia Pacific geographies, we delivered good growth across key markets, especially in South Africa, Western Africa, and Indonesia, resulting in a 12% revenue growth overall for this region compared to the same quarter last year. Lastly, on our Q2 results, our commitment to disciplined cash management and operational efficiency remains strong. We continue to optimize our inventories, receivables, and payables to achieve sustained and best-in-class working capital efficiency. To this end, I am pleased to report that we've achieved a strong reduction in net working capital days compared to the same quarter last year. Turning to our outlook for the third quarter and full year of FY26. Based on our momentum, we are confident in accelerating our growth in the second half of the year. From an SG&A standpoint, we continue to leverage advanced tools and technologies to optimize operations across all functions, enhancing our operating model and driving an enterprise-wide transformation. At the same time, we're strategically focusing our SG&A investments to accelerate growth in key priority areas. On the marketing excellence front, we continue to strengthen our new product pipeline, positioning ourselves to firmly surpass our target of $130 million revenue from new product launches this year. We are already seeing excellent results from products launched in the first half of the year, especially in Latin America, underscoring the growing acceptance and differentiation of our portfolio in the market. Looking ahead, we expect this momentum to accelerate in the coming quarters, further strengthening our market position and driving sustained growth. In closing, I'd like to thank our team for their outstanding dedication and our channel customers for their continued partnership, which drove this quarter's successful results. With this solid momentum, I am confident we will deliver robust revenue and margin growth through the remainder of this year. Thank you. And with that, I'll hand over to Bikash, who will take you through the performance of our other platforms.
Thank you, Mike. Let me now also provide a quick update on our other three platforms, which are our India crop protection business, our UPL SAS, Advanta, our seeds platform, and our specialty chemical focused platform, Superform. UPL SAS revenue declined by around 10% due to lower volumes led by unfavorable weather conditions that prevailed in most part of the country. Herbicides was the segment that was particularly impacted. However, despite the above challenges, we improved our contribution margin by approximately 500 basis points, driven mainly by improved product mix and recent launches such as Centurion Easy and Canora Easy. The EBITDA margins improved from around 20% last year to 22.7%, an increase of nearly 270 basis points. This led to an absolute EBITDA growth of 2% despite revenue decline. Advanta, now integrated between our seeds and post-harvest platform, delivered a strong 26% growth year-on-year, fueled by a robust volume expansion of 14% in the seed segment. Key contributors to this growth included corn in India, Latin American countries, and Indonesia, as well as sunflower in Argentina. Our platform EBITDA rose by a strong 57%, driven by higher volumes. Superform had a steady revenue versus last year. I am happy to share that our super specialty business, or SSC, was up by 18%, driven mainly by volumes led by contract manufacturing. This strong growth has also helped us improve our non-AgChem revenue share to around 25% compared to 20% last year Q2. The platform reported a contribution margin of around 25%, up by a strong 370 basis points. This was driven by improved mix and increased share of super specialty segment. EBITDA is up by a strong 24% versus last year, with 250 basis points improvement led by increase in contribution. Now on some non-financial updates would like to talk about. In line with the previous quarter where we presented our ESG commitments, I am pleased to add here that our robust financial and business performance are also enabled by our state-of-the-art backward integrated manufacturing and world-class R&D capabilities. Our global manufacturing facilities spread across major continents enable effective catering to growers and customers' unique needs, offering bespoke solutions enhancing agricultural results. Our strategically located facilities, backed by advanced synthesis capabilities, a skillful and inspired team, provide us favorable cost position versus most of our global peers. Our world-class R&D centers, distributed across the globe, fuel innovation for our customers, whether through synthesis and formulation or creating process IPs, quality improvement, or otherwise. With a strong team within this function comprising PhDs and experienced professionals, we have received over 3,000 patents. Now to summarize, Q2 has been an extremely positive quarter with several achievements. This quarter has been much stronger versus an already robust Q1, with broad-based EBITDA improvement and focus on overall quality of earnings led by financial discipline. Through this, our first half of the year looks strong as well on almost all indicators. On the P&L front in Q2, our revenue grew by a robust 8% versus last year, a strong contribution margin at around 42%, an improvement of 420 basis points, a strong EBITDA growth of 40% with margin improvement of 410 basis points, PATMI improvement of around 1,000 crores. Similarly, on the balance sheet, our working capital days improved by 5 days from 123 days to 118 days. Improved net debt with a reduction of over $600 million. Adjusting for redemption of perpetual bonds of $400 million, the net debt reduction is $1 billion. This also resulted in further de-gearing our balance sheet. Considering our strong H1 and positive outlook for H2, I am pleased to share our upgraded FY26 guidance as follows. 4 to 8% growth in revenues on similar lines to what we presented in Capital Market Day in May, and 12 to 16% EBITDA growth versus last year, up from 10 to 14% as indicated earlier. Finally, I would like to thank our team for their efforts and our valuable stakeholders for their trust and support. I am confident of delivering our financial commitments in FY26. Thank you, and I look forward to your questions. With this, we are now open for Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Saurabh Jain with HSBC. Please go ahead.
Thank you for the opportunity and congratulations on a stupendous set of results. First thing I wanted to clarify on your ECL in Brazil. So how much is the total ECL in first half? Because there was some commentary about 1Q, about 13 million, and then some of it got reversed. What is the total ECL in the first half for you?
Saurabh, maybe I'll take that from a UPL Corp standpoint. Bikash, you can add any commentary you want from an overall UPL perspective. In UPL Corp, our ECL in the first half was $30 million US dollars, and that compares to $23 million last year, so up $7 million versus the same half last year. And you mentioned Brazil. That's total, so that's not only Brazil. That's our global ECL for the half.
So can you split it out into the first quarter and second quarter also? Just trying to understand how much was the amount in the second half, because you also mentioned about some reversal. That is where I'm coming from.
Yeah, so the net in Q2 is $9 million, and the total in H1 is 30. So you can say net in the first quarter of 21.
Yeah. Okay. Thanks. Also, there has been a bit of pricing decline in the second quarter amid some reports suggesting some of the products have seen price increases. What would be your assumptions and expectations in the second half, whatever growth that you're going to deliver, can you split it out in terms of how much would be volume, pricing, and Forex?
Yeah. So as I mentioned, for the most part, we're seeing prices have stabilized. So now on the price side, it's primarily a mix impact. Now we did see, as I mentioned, with Sperto, which is one of our high value branded insecticides in Brazil. This year we have seen some clones and generics come into the marketplace, and so we have seen some price declines specifically on that product, which is a large product for us. But on the rest of our portfolio, we've seen very consistent pricing. So as we think about the H2, our growth in H2 will be almost exclusively volume driven. We expect prices to be roughly flat, maybe down like again 1% or so in Q3, but overall in the second half we expect pricing to be very flat, but volumes to lead the growth for our second half business.
Okay, that is useful. One last question I would ask, and then I will join back the queue. Given already we have seen 2 quarters and there is good debt repayment that UPL has delivered, there is also a debt repayment obligation which is coming up in March 2026. I think it would be about $500 million or so. Can you also, explain to us what is your potential expectations of your debt by when you end this year?
Yeah, sure, Saurabh. Thanks for the question. And as you know that we have opening cash balance of about $550 million as on 1st of October. We also have unutilized working capital lines of about $1.7 billion. And significant cash release happens during H2. And the last 2 years, if you look at it, the cash release has been in the range of $900 to $1.1 billion. So we feel very comfortable with our opening cash that we have. And during the H2, the cash release that will happen. So we are quite confident to meet any repayment obligations for this year. So I think that is not a challenge. The second question is about what is our expectations for rest of the year and the end of the year. Like last year, we had ended at 1.7 times net debt to EBITDA ratio, and adjusting for PAF, it was about 2.1 times. Post repayment of the perpetual bond, we had made the second and final call on the rights issue for the balance amount of approximately $200 million, which is also received in September. And our focus is to continue to drive cash generation from operations, which is supported by the disciplined working capital management, as you can see it in our H1 results as well. So we will be significantly lower than the last year at 2.1 times on a business as usual basis. And our short to medium term priority is to deleverage our balance sheet. Probably I will say between 18 to 24 months time. So compared to last year of 2.1 times, we are expecting somewhere between 1.6 to 1.8 times of gearing. But still we have S2 to deliver, and we'll see how things evolve. But as of now, we are quite comfortable with our cash position, quite comfortable on our net debt and the leverage ratios.
So does that imply a net debt reduction of about 1,500 to 2,000 odd crore rupees? Is that the way we should look at it?
Yes, so we'll see that how the working capital pans out in Q4. Q4 is our key quarter from working capital, cash flows and net debt perspective. But as of now, we are planning somewhere between 1.6 to 1.8 times.
Yeah, so a related question is that the working capital on a YY basis has seen an increase, right? There is a drawdown on the working capital. Would you still believe for the full year basis, there would still be some release of working capital, or you would believe that there would be